Hello and welcome to the Wright Know Your Money podcast. I'm Ashley Smith.
And I'm Tom Richards.
On the Know Your Money podcast, we talk everything finance, from financial planning tips to how what's going on in the world around you affects the money in your wallet and, most importantly, your financial future.
If this podcast helps you, please like and subscribe so we can help as many people as possible moving forwards. In today's episode, we're going to discuss income tax and an often overlooked, unknown 60% tax rate. So, Ashley, over to you. Could you just explain that very briefly for us?
Yes, I can. So, they say there's only two things guaranteed in life: death and taxes. And if you're aware of the income tax system in England and Wales, you possibly already know that your income is taxed at a rate of anywhere from 0 to 45%. If you're not aware of it, a quick Google search will take you to the HMRC website, which confirms the following tax bands. So the first £12,570 you earn is completely tax-free. From £12,570 up to £50,270, you're taxed at 20%. Over that £50,270, all the way up to £125,140 from April 2023 will be taxed at 40%, and anything over the £125,140 is taxed at 45%. Now, although these are the official tax rates, there is a point that we want to make in today's episode, and that's that there is often an overlooked or simply unrealised 60% tax rate on your earnings. Now, that's not an error in what we're saying here. 60% is correct, but the reason that you won't find that published on HMRC's website is because it's not a direct tax. You don't actually have a 60% tax rate within the income bands. Effectively, what happens is it occurs when your income is over £100,000, because there is a tapering of your personal allowance. So that first £12,570 that is tax-free, you actually start to lose that once you earn over £100,000. Now, based upon official figures, a little bit out of date now, but from 2019-2020, 950,000 people were earning between 75,000 and 100,000, so just underneath that £100,000 threshold for this 60% tax trap. Recent figures in the Telegraph Money show that nearly 1 million more workers will face paying this 60% tax over the coming few years. So it is becoming a very, very important and a much sort of more important topic for people than it has been in the past.
That's really interesting, Ash. Thank you for that. Could you explain to our listeners, how does this tax trap occur, and probably why do not many more people know about it?
I think first of all, it's not a commonly known sort of tax rate because, as I say, it's not an official tax rate.
Yeah.
It's an effective tax rate. So what I mean by that is, once you earn £100,000, every sort of £2 of income that you earn over that, your tax-free allowance, that first £12,570, is reduced by £1. So if you earn £125,140, your personal allowance completely disappears, and you will pay tax on all of that income up to that point, instead of having that first little bit tax-free.
No, that's brilliant. Thank you. Could you now just possibly put that into a real-world example for us, just so someone can relate to it?
Yeah, so let's just say you're right on that threshold. You earn £100,000 as a salary. You then receive a £1,000 bonus. So that £1,000 bonus, based on the tax bands, will be subject to tax at 40% or £400. Because you're also £1,000 over that £100,000 threshold now, you'd also lose £500 of your personal allowance. So that £500 is now going to also cost you 40% in tax, or £200. So you've paid £400 tax on the £1,000 as it starts, and then because you've lost your personal allowance or part of your personal allowance, you are now paying another £200 worth of tax. So that's £600 on a £1,000 bonus, or 60%.
Yeah, it's such a significant number. And I think the magic question for all our listeners is there anything that they can do to remove this tax burden by speaking to a financial advisor like yourself?
And there is, yeah. So put simply, you need to reduce your income. Now, that doesn't mean that you want to reject a bonus or reject a pay rise, or when you go into your to a new position, say, I don't want to be paid any more than the £100,000. But what you can do is use those funds in a different way, so that you still benefit from those funds, but don't then necessarily have that huge 60% tax rate. The most common ways of doing this is quite simply using pension contributions. So sticking with that example of a £1,000 bonus for someone who's already earned £100,000, rather than pay that 60% tax on it and be left with £400 at the end, you could pay directly into your pension a £1,000 contribution. So you effectively salary exchange. You swap that £1,000 bonus for a pension contribution. You keep your income below the £100,000, and you also then get £1,000 into your pension with no tax deductions on it. So
sounds much better.
It does. So it brings your income down back below that rate there. Now, if you're not able to make a contribution by salary exchange, perhaps because your employer doesn't offer the ability to do that, you will unfortunately have your income, you'll be taxed on it, but you can make a personal pension contribution. And when you do that, the scheme that you pay into will automatically claim 20% tax relief directly from HMRC. So there's the first 20% back. When you then submit your tax return at the end of the year, or your accountant submits that for you, you can claim the rest of that tax relief back on that as well. So you still get that money back, you still avoid that 60% tax trap, but it just takes a little bit longer for that money to filter back through to you. Now obviously that's the option that we deal with most at Wright, and if that's something that you as a listener would like to have a look at and explore, if your income is over the £100,000 threshold, then please do get in touch with us. Please speak to one of our financial advisors and we'll be able to assist you with that and make sure that if we are going down that route that you're not breaching any other allowances such as your annual allowance. So that's the thing that we would sort of look at there for you. Whilst we do, for the most part, use pensions within Howard Wright to reduce income, there are other options available as well, depending upon your employer and any schemes that they may or may not offer. Some of those schemes will include the Cycle to Work scheme, which effectively allows you to do exactly the same thing in that you give up some of your salary or exchange some of your salary, but you use that money to purchase a bike rather than pay into the pension. One which is quite popular is childcare vouchers. So the government allows you to exchange your gross salary before tax, national insurance for childcare vouchers, which you can then use to pay for your child's childcare, as the name suggests. So lots of different ways there that you can sort of reduce or keep your income below that £100,000 threshold without actually sort of refusing or giving up that salary and or bonus and then saying no thank you. So you still benefit from the funds without that huge 60% tax issue on there. Thank you very much for listening to the Howard Wright Know Your Money podcast. I've been Ashley Smith.
And I've been Tom Richards.
If you're watching this on YouTube, please like and subscribe or share on your socials. And if you're listening to us on Apple Music or Spotify, please drop us a follow and leave us a review.
It really helps other people find the podcast, enabling them to know their money better and build stronger financial futures. Please also check out our Howard Wright link tree, which will be at the bottom of this video or podcast, and also stay tuned for future episodes. Thank you for listening.
This recording contains information from sources believed to be reliable, but no guarantee, warranty or representation express or implied is given to its accuracy. Howard Wright does not undertake any obligation to update or revise any future statements. Past performance is not a reliable indicator of future results. Investments can go down as well as up, and actual results could differ materially from those anticipated. This recording is for the information purposes only and has no regard to the specific investment objectives or financial situation of any individual. The information contained in this recording is not intended to constitute and should not be construed as investment or financial advice. Appropriate personalised advice should always be taken before entering into any transactions. No responsibility can be accepted for any loss arising from action taken or refrain from being taken based on this publication. Howard Wright is authorised and regulated by the Financial Conduct Authority.